Have you checked your bank account recently and wondered why certain payments keep disappearing every month even though you may not legally owe them anymore? Because right now, in June 2026, millions of seniors across America are still paying bills they may actually be exempt from. Not because they failed to qualify, not because they missed a deadline, but because nobody told them the rules changed. Nobody mailed them a notice. Nobody called their phone. Nobody knocked on their door and said, "You can stop paying this now." The money simply keeps leaving their account month after month while they assume everything is correct. Today, we're going through 5 bills that many seniors are legally exempt from paying in 2026, along with the exact steps you can take to find out whether these exemptions apply to you. And stay until the end because the 5th one is costing some retirees hundreds of dollars every single month, and many people do not discover it until they've already overpaid for an entire year. If you're new here, subscribe and turn on notifications. This channel focuses on Social Security, Medicare, retirement benefits, taxes, and financial rules that affect seniors directly. Let's get started. Number 1. Federal income tax withholding on Social Security benefits. This is one of the easiest bills to stop paying if you no longer owe it, and yet millions of retirees continue having money withheld from their Social Security checks every month. Here's why. Years ago, when many retirees first started collecting Social Security, they filled out a form called a W-4V. That form allowed them to voluntarily withhold federal income taxes from their monthly benefits. The Social Security Administration simply follows those instructions every month. The problem is that your income situation may have changed dramatically since you first completed that form. Maybe you retired completely. Maybe investment income declined. Maybe pension payments changed. Maybe your spouse passed away, yet the withholding continues automatically. The Social Security Administration does not review your tax return before taking that money. They simply continue following the original instructions. Here's the important part. Many seniors no longer owe federal taxes on their Social Security benefits at all. For a single filer, benefits generally are not taxable when provisional income remains below $25,000. For married couples filing jointly, the threshold is $32,000. If your income falls below those levels, every dollar being withheld could essentially be an unnecessary prepayment. Now, some people eventually receive that money back through a tax refund, but why give the government an interest-free loan throughout the year if you don't owe the tax in the first place? The solution is simple: review your income. If withholding is no longer necessary, complete a new W-4V form and submit it to Social Security. Many retirees discover they can immediately increase their monthly cash flow simply by updating paperwork they haven't looked at in years. And in an economy where every dollar matters, that extra money can make a meaningful difference. Now let's move to the second exemption, because this one is brand new and many tax preparers are still missing it. Number 2, the new senior tax deduction. This deduction was created specifically for older Americans and is available for tax years beginning in 2025. If you are age 65 or older, you may qualify for an additional deduction that reduces your taxable income beyond existing standard deductions. And surprisingly, many seniors still don't know it exists. Think about that for a moment. Congress creates a benefit designed specifically for retirees. Millions qualify, yet countless people never hear about it. The reason is simple. Most Americans assume tax software automatically catches everything. Most people assume their preparer knows every rule. Most people assume someone else is watching out for them, but tax law changes constantly. And when major legislation is passed, implementation often takes time. That creates a dangerous gap. The people who qualify may never realize the deduction exists. Let's look at an example. Suppose a retired couple has income near a tax threshold. A deduction worth several $1,000s could reduce taxable income enough to lower their overall tax burden substantially. That's real money staying in their household instead of going out the door. The problem is that if nobody claims the deduction, the savings disappear. Before filing taxes this year, ask one simple question. Did you apply every senior-specific deduction currently available? Ask it directly. Don't assume, don't guess, get a clear answer. A 5-second question could potentially save hundreds or even thousands of dollars. Now let's move to the third bill, and this is where the numbers become much larger. because millions of seniors qualify for help and never apply. Number 3. Medicare Part B premiums. Every month, Medicare Part B premiums are deducted before many beneficiaries ever see their Social Security payment. For most retirees, this deduction feels automatic. They assume everyone pays it. They assume there is no alternative, but that's not true. There are federal programs specifically designed to pay those premiums for qualifying seniors, and many eligible people have never even heard of them. These programs fall under what are known as Medicare Savings Programs. The goal is straightforward: help lower-income Medicare beneficiaries afford health care. Yet year after year, millions remain unenrolled, not because they were denied, not because they failed eligibility requirements, simply because they never applied. Think about that. Imagine paying a bill every month for years while a program exists that could have paid it for you. That's exactly what's happening right now. One of the most comprehensive programs is called Qualified Medicare Beneficiary, or QMB. For those who qualify, the program can pay Medicare premiums and significantly reduce out-of-pocket medical expenses. There are additional programs for people with slightly higher incomes as well. And here's where many seniors make a mistake. They assume they're over the income limit, so they never apply. But income calculations are often more complicated than people realize. Certain exclusions and deductions may apply. Some states use different thresholds. Some states provide expanded assistance. The only way to know for sure is to ask. The process starts with a phone call. A simple conversation can determine whether thousands of dollars in future healthcare costs might be reduced or eliminated. Healthcare is one of the largest expenses retirees face. Even modest savings compound year after year. And that's exactly why this exemption belongs on today's list. Now let's talk about something that affects homeowners, because this next bill has been quietly rising across the country. Number 4, property taxes. For many retirees, the mortgage is gone, the house is paid off, yet one bill never disappears. Property taxes? And in many areas, those taxes continue rising year after year even when household income remains unchanged. Here's what many homeowners don't realize. Almost every state offers some type of senior property tax relief. The names vary, the rules vary, the application process varies. But relief programs exist nearly everywhere. Some states reduce assessed property values, some freeze assessments, some provide credits, some allow tax deferrals, yet the overwhelming majority of these programs share one thing in common. They're not automatic. Nobody enrolls you, nobody fills out the paperwork for you. Nobody calls to remind you. The burden falls entirely on the homeowner. Imagine living in the same house for 20 years. Imagine paying thousands of dollars in taxes annually, then discovering you qualified for relief all along. That happens more often than most people realize. And as home values continue increasing in many parts of the country, the value of these exemptions becomes even more significant. This is especially important for retirees living on fixed incomes. A rapidly rising tax bill can create financial pressure even when the home itself is fully paid off. That's why every homeowner over age 60 should contact their local assessor's office and ask a simple question. What senior property tax relief programs are available in my area? That one question could uncover savings opportunities you never knew existed. And now we come to the 5th bill. The one that may be costing some seniors the most money of all. Number 5. IRMAA Medicare surcharges. If you've never heard the term IRMAA before, you're not alone. Most Americans don't learn about it until Medicare sends them a notice. IRMAA stands for Income-Related Monthly Adjustment Amount. It's an additional Medicare surcharge applied to higher-income beneficiaries. The concept sounds simple. People with higher incomes pay more, but the way the system works creates a major problem. The income being used may no longer reflect your reality. Medicare doesn't look at what you're earning today. Instead, it typically looks back 2 years. That means your current premium may be based on income from an entirely different stage of life. And that's where trouble begins. Imagine someone who retired recently. Their final working year included bonuses, unused vacation payouts, commissions, or stock compensation. Income spikes temporarily. 2 years later, Medicare reviews that income. Suddenly, a retiree living on a modest fixed income is being charged higher premiums because of a financial situation that no longer exists. This happens constantly, and many beneficiaries assume there is nothing they can do about it. Fortunately, there is. Certain life-changing events may allow Medicare premiums to be recalculated using more current income information. Retirement, loss of income, death of a spouse, certain other qualifying circumstances. When these events occur, beneficiaries may be able to request a review. The difference can be substantial. Some surcharges amount to hundreds of dollars every month. That's thousands of dollars annually. Yet many retirees continue paying them because they don't know a review process exists. They assume the government already knows their income changed, but the government only knows what you tell it. And that's the recurring theme throughout today's video. Every exemption we've discussed works the same way. The opportunity exists, the qualification exists, the savings exist, but the responsibility to ask belongs to you. Nobody is proactively searching for ways to reduce your bills. Nobody is reviewing every account to see whether you're overpaying. Nobody is calling to explain every program available, and that reality surprises many people, because most retirees assume government agencies automatically communicate these opportunities. In practice, many benefits remain hidden behind forms, applications, and eligibility reviews. That's why information matters. A single phone call can uncover a benefit worth hundreds of dollars. A single application can eliminate years of unnecessary expenses. A single question can reveal a program you never knew existed. Let's quickly recap all 5. Number 1. Review Social Security tax withholding and determine whether federal taxes are still being withheld unnecessarily. Number 2. Make sure any available senior tax deductions are properly claimed before filing. Number 3. Investigate Medicare savings programs that may pay Part B premiums and reduce healthcare costs. Number 4. Research senior property tax relief programs available in your county or state. Number 5. Review any Medicare IRMAA surcharges and determine whether changed circumstances justify a recalculation. Notice the pattern. Every one of these involves money leaving your pocket. Every one of these requires action. And every one of these affects people who often assume the system is already handling everything correctly. That assumption can become expensive. The reality is that retirement finances require active management, not because seniors are doing anything wrong, not because the programs don't exist, but because eligibility rules, deductions, credits, exemptions, and appeals often require a request before they take effect. The people who save the most money are often not the wealthiest. They're simply the ones who ask questions, they read notices, they verify deductions, they review benefits annually, and they challenge assumptions. So this week, set aside 30 minutes. Review your Social Security deductions, review your Medicare costs, review your property tax bill, review your tax return, and ask yourself one question. Am I paying for something I no longer legally owe? Because if even one of today's 5 exemptions applies to you, the savings could continue month after month and year after year. And unlike an investment gain or a market return, this is money you may already have. It's simply money that stopped leaving your account unnecessarily. If this information helped you, share it with a friend, neighbor, sibling, or parent who receives Social Security or Medicare. There's a good chance someone you know is still paying one of these bills without realizing an exemption or reduction may be available. The system has rules. The programs exist. The savings are real, but nobody benefits from information they never receive. Thank you for watching, take care of yourself, and I'll see you in the next video.